Let's take a look at Chapter 4, and we'll start with question 22 right here. So Diego transfers real estate with an adjusted basis of $260, fair market value of $350, to a newly formed corporation in exchange for 100% of the stock. The corporation assumes a liability in the transferred real estate in the amount of $300,000. Determine his recognized gain on the transfer and the basis for his stock. So remember why he's doing this and part of what the chapter is about. He is going to form a corporation, and to do that he's going to transfer property he already owns, the basis, the fair market value, and then of course there's also a liability in the property. So all those has to come into play to determine what that is. So I've got an Excel spreadsheet ready to go to figure that out. And so we can see what will happen here. So the first thing to realize is this is under what they call Section 351, and the amount that is realizing is what he is getting. He's getting stock, and he is getting release on liability of the real estate. And so the stock that he's receiving is based on what he's giving up. So he's giving 350 of value is what he's getting, but he's giving up that liability of 300,000. So the difference between the two is the amount realized, that 350 market value minus the $300,000 liability. So the stock right here is 350 minus 50. Okay, so that 350 minus 300,000. Let me get that right. There you go. So 50,000 left over. Then he has a release of the liability on the real estate. Okay, and so the sum of the two is 350. And then he has to subtract from that the basis on the property. Okay, his original basis. And then that will trigger a gain. So that 350 minus the basis is a gain of 90, but he's only going to recognize gain of 40, and that gain of 40 is the 300,000 release on the liability minus the 260 release on the basis. So that's basically it right there. So there's a gain realized of 90, recognized of 40. So then the basis of his stock is the next part. So what's the basis of his stock? Well, the basis will start out with basis of asset transferred. And so that was the 260. Then the release of the liability, the 300,000. And then what's left over is gain, which is 40,000. So the gain recognized is 40, but the basis is 0 because these two offset right here. Okay, those two numbers offset, and the basis is 0. So he's got a 0 basis and realized gain of 90, recognized gain of 40. And question 23 is very similar. This is Yvonne and Simon. They form Ion Corporation. Yvonne transfers equipment, basis of 110, fair market value of 165, and Simon invests 130 of cash. They each receive 100 shares in Ion worth 130, but Yvonne also receives 35,000 in cash from Ion. Calculate Ion Corp's basis in the equipment. In addition, determine the basis for both Yvonne and Simon in the stock. So we'll go back to Excel. I've got a little spreadsheet built to do that one also. And so what was realized in this is, we'll go back to the question here, and we've got 130 of stock, and we've got 35 of cash. Okay, so 130 of stock and 35 of cash. So the sum of the two is 165. We subtract from that the basis of the equipment, which was 110, and the difference is a gain. So the gain realized is $55,000. The gain recognized is $35,000 because that's the amount that she received. So go back to the question, and that cash that she received right here is $35,000. That is what they call the boot. Oops, I have gain realized there twice. The second one should be gain recognized right here. So the gain recognized is $35,000. So the gain recognized is $35,000. That represents the cash received, which they call the boot. Okay, that's where that $35,000 came from. And then for Yvonne, her basis down here. So this is Yvonne's basis down here, and we look at the basis of the asset transferred, the $110,000 on the equipment, plus the $35,000 in cash that she received, plus the gain recognized on that, and then minus the boot received. And so that's just minus the $35,000 again. Okay. So basically she was just paid for her gain. We sum those all up, and her basis is 110. Okay. So Yvonne's basis is 110, and Simon's basis is 130, which is the cash that he paid, if you're wondering what that is. And then for Ion, what's basically the basis for Ion of this equipment would be a question. It's 145. For Ion, the corporation, its basis is the 110 plus the 35, which is the 145. Okay, we'll do one more question, which is question 24. And it says here, actually do two more, 24 and 25. Chaz transfers cash of $60,000 to a newly formed corporation for 100% of the stock. In its initial year, the corporation has net income of $15,000. The income is credited to earnings and profits account. The corporation distributes $5,000 to Chaz. How do Chaz and the corporation treat the $5,000 distribution? It basically becomes a dividend. So the $5,000 corporate distribution to Chaz is considered a return on the corporation's profits, which is a distribution of earnings and profits, and it's taxed as a dividend. The corporation is not allowed to claim a deduction for that because it's a dividend. Okay, so A is basically it's a $5,000 dividend that he receives. For part B, it says assume instead that Chaz transfers to the corporation cash of $30,000 for stock and cash of $30,000 for a note of the same amount. The notes payable in equal annual installments of $3,000 each, beginning at the end of the corporation's initial year of operations, and bears interest at the rate of 6%. At the end of the year, the corporation pays an amount to meet this obligation. The annual $3,000 principal payment plus the interest due determine the amount of the payment and its tax treatment to Chaz and the corporation. So it's a little bit different now. So the corporate payment to Chaz is $4,800. That's the $3,000 plus, we'll do a little calculation over here, plus a interest calculation. So we're going to basically take $30,000, the loan, and then take that times 0.06, do the calculation here, and we get $1,800. So $1,800 plus $3,000 is $4,800. And then of that money that he receives, the $4,800, $3,000 is basically is not taxable. It's return of the amount owed to him. It's principal received. That's not taxable. It's just money returned that was lent. But the $1,800 is interest income to Chaz, and it's also a deductible interest expense for the corporation. Okay, now the last one's 25. Several years ago, Min Jun, who is single, acquired Section 1244 stock in Blue Corporation at a cost of $60,000. He sells the stock for $5,000 the current year. What is the amount of gain or loss realized during the year? Okay, so you can kind of do the mental math and go, well, it had a cost of 60 and we sold it for 5, so it's a $55,000 loss. So the question is, what do we do with that? And this is a fully taxable transaction, and it does produce a loss of $55,000. And the answer would be, typically, stock investments are considered capital assets, and gain or loss is recognized on disposition, and there would be a capital gain or loss treatment. However, because this is Section 1244 stock, which is called small business stock, up to $50,000 of the loss, $100,000 for a married taxpayer filing a joint return, is given the ordinary treatment. Therefore, as a single taxpayer, $50,000 of this loss is ordinary, and $5,000 is a capital loss. So he can take $50,000 as an ordinary loss and $5,000 as a capital loss. And that would be the answer, because it's Section 1244, which is small company stock.